everyone. Good afternoon. I'm aware that we're sort of 1 minute behind. We've still got some people attending, but we will sort of roll into the presentation as we have a few more people still continuing to log in and attend. Just in terms of saying, hello, this is our last one of the year, so that we're sort of doing a little bit of a look back at some of the occurrences that we've sort of all gone through collectively in 2020, but also, as we'll sort of talk a little bit more about, we are increasingly, and have been for the last month or two, looking forward into 2021 and already starting to have a lot of discussions about this resumption of consumption and what the sort of the new world is going to look like, given that we now have distributions of vaccines underway here in the UK. Just in terms of this afternoon, I'm joined by our usual motley crew from the investment team. We're casting eyes around the equity market, fixed income market, and we've also got, apart from the macro overview from James, and then we're going to finish up at the end with some insights and input from Annie on the ESG side. So we've got a little bit more of a diverse end to the year than the normal, and this is building into what we're going to be trying to do into 2021 by pulling in interesting topics that we're seeing that are relevant, being reflected as to recent market movements and news. I think ESG is one that has been catching the headlines quite a lot over the last 6 or 7 months and is garnering increased interest by investors around the world. So before we begin, this is being recorded. That does mean that you will be sent a link to the recording afterwards, so you will be able to watch this as many times as you like. We have got a Q&A function box down at the bottom, so if there are any questions that come up during a speaker section, feel free to type them in and we'll address them at the end of the section. And if we do miss any, we will have a little bit of time at the end where we can do a recap. And then we will have on the very, very last slide some contact details. So if you have any outstanding questions, you can always reach out directly to us or to your relationship manager for additional information. Anyway, so moving on just briefly to performance, being sort of 11 and a bit months into the year, which has been fairly shocking from a sort of global consumer perspective. Luckily for us, not so much on the performance front, having mitigated a lot of the negative markets that we saw in March. We're now in the position towards the end of the year where we've got strong risk-adjusted returns, and we're looking at this from a sort of annualized return versus annualized volatility perspective, and all 9 of our multi-asset portfolios are sitting in that category. Although we are underweight risk, and we will be talking through a little bit some of the reasons and rationale behind that, we have been continuing to increase risk in November, and also as we've been going into December as well. So that's on a constant increase at the moment. But as I said, we're now looking at our positioning for 2021, which is a year from our perspective where we think it's going to be more about being nimble, strategic, and more driven around your exposure and where it is and when you hold it, rather than just generally how much risk exposure you have in your portfolio. So just so looking briefly at performance, we were positive for all 9 multi-asset models, not surprising given the very, very strong equity markets that we saw in March. Some of our target returns, being the absolute return focused investors that we are fairly low on a month-to-month basis, which is easy to beat when we are looking at positive equity markets. But if we sort of skip on to the year-to-date performance, and this is where it's worth just spending a little bit more time, although we list the private client index just for comparative purposes, I mean, we're really looking at this from a target return being the inflation plus the spread depending on the risk profile of the client. So we have got very strong performance across the board, as I said at the beginning, partly on a risk-adjusted basis versus our peer group, who have got much more volatile performance numbers, but also more importantly for us against our target return. Where we are going to be running into some fun challenges is 2021, given that we have seen some very, very positive markets into the end of the year. Just taking a brief look at our allocation, Whilst it doesn't look like too much has changed at a headline level, you can see second line from the bottom, global equities, where we've been taking up our exposure to equities by a couple of percent, and that's just been rotating out of some of our fixed income holdings. So as I said, remaining overall underweight. We run our balanced model with a sort of neutral allocation of equities of sort of 40% at the moment. So we are sitting at roughly 30% out of the 40% total. So that's that sort of 3/4 risk on, which Michael may well be referencing in the equity section. So just before we sort of pass across to James, I think if we have got any questions, now's the time to ask them. But otherwise, just to sort of finish up and say that we've had a very, very bumpy 2020. I think from my perspective and from the team's perspective, we're comfortable and happy with how we've navigated through that. 2021 is setting itself up to be a very interesting year from an opportunities perspective. And I think a lot of what you're going to be listening over the next hour or so is focused on where the environment is, where it's going, and how we can be positioned. So without further ado, I will pass across to James.
Thank you very much, Simon. And great, sorry about that, technical difficulties. Thank you, Simon. So, right, where to begin? Good news, I've taken a vow not to use the phrase unprecedented. So hopefully I'll come up with new words to say that word, which means we've never seen this before. Here's how I see the macro picture sort of evolving as we go into 2021. Visibility on the vaccine, which has just started to roll out here in the UK, is very positive, as is the continuation of an extremely stimulative fiscal and monetary policy structure. So we're going to have, I think, extremely strong growth in 2021. The problem is, everything is extremely expensive. So long-term, your returns are going to be really disappointing. And I'm going to spend some time talking about that. And equally disturbing, bonds are not going to give you any protection if we have a sell-off. And sell-offs are sort of inevitable given the outlook that we see. So how to trade this? Well, we think that macro factors are going to drive a lot of returns dispersion. So even though we think that things are expensive and are going to stay expensive, but just sort of move sideways in a wide range, wide and sideways, fat and flat, those macro factors driving the dispersion are going to give you some tactical opportunities. So that's how we're thinking about the world at this point. So let me just start by saying that the financial backdrop for the market, the financial conditions that the market is looking at right now are, oh wait a minute, I can't say unprecedented, can I? Are quite never been seen before. On the left-hand side, we have the U.S. Financial Conditions Index, and this is produced by Goldman Sachs. And what they do is it's basically just sort of a sophisticated weighted average of things like credit spreads, interest rates, equity prices, P&E, et cetera. And what it does is it measures the amount of financial support or liquidity that the private sector has. So the lower the number, the more liquid it is. The higher the number, the tighter it is. You can see we've basically never been easier on the financial side. So not only has the Fed given firms as much money as they possibly could want, but equity markets are giving firms basically as much money as they could possibly want. And those two things are linked. So that right there sets you up for a very, very strong 2021. And that is going to enhance and be enhanced by a very strong cyclical outlook. So on the right-hand side, if you have a look at that, I guess that color is teal. It's sort of that greenish blue line. That is U.S. industrial production, percentage change over a year ago. And you can see that it's very tightly related to the S&P 500's forward earnings per share growth, change in the EPS, percentage change year over year. So the two of those are really set for a pretty meaningful bounce. Next year, To be honest, given the negative base effect of 2020, the extraordinary fiscal stimulus and monetary stimulus, and the pent-up demand that's going to be unleashed from the vaccine, 2021 could be one of the best years we've seen in decades in terms of year-over-year growth. The problem we have here is that your bonds are not going to be able to protect you if something goes wrong. So typically what you would do is you would look at a world where you've got an equity portfolio, and when the equity markets turn down, then your bond position would gain value, and that would help to hedge your losses. So what I'm showing you here on the left-hand side, this is the cumulative returns from the start of a drawdown for the times when the S&P has fallen by 10% or more since 1990. So in the past 30 years, there have been about a half a dozen 10% or more drawdowns in the S&P 500. If you look at how much the S&P fell from the start of those drawdowns, you get the red area that's sort of underneath the line. And then what I do is I ask, okay, once that clock starts ticking for the sell-off, for the drawdown, how much do you make in the bond market? And it's pretty clear that when you really, really needed it, so back in the early 2000s recession, in the Great Recession in 2008, when equity markets got absolutely hammered, the bond market protected you. You had a hedge by having a position in fixed income. If you go look at the right-hand side of the screen, the U.S. Treasury 3-month. This is just the interest rate that you were getting on the 3-month Treasury over that period. And you can see, so in the early 2000s recession, the Treasury 3-month went from 6% to about two and a bit. So it's a 4.5 percentage point move. And then in the Great Recession back in 2008, the 3-month again went down about 4 percentage points. 400 basis points were given to the market. And that is what drove those phenomenal bond market returns, which helped to protect you during your equity sell-off. We got a problem. The problem is that right now returns are absolutely flat at zero. There's no place for Treasury returns to go. They can't go any lower here. So they can't protect you in the next sell-off unless the Fed allows interest rates to increase. But the Fed can't do that. And that's a subject that my colleague Jeff is going to talk about in a few minutes, because of the debt burden that is hanging over both the public sector and the private sector. And the same really applies around the world. So you're not going to get protected if you're holding bonds in your portfolio for the next few years. The issue here really kind of is driven home by the fact that no part of the fixed income market has a lot of room to get more expensive. So if you look on the left-hand side, I think I'm gonna call it teal, the teal line, the sort of greenish blue line, US 2-year government yield, like the 3-month that I showed you before, you can see that during recessions, which are those gray bars, it comes off. That's the government helping out, and it's absolutely pinned at zero now. So it can't go any lower. Now we've had a bit of a backup in the yield curve, so the 2s to 10s have steepened just a bit. Normally, you would have expected a lot more steepening. That's not happening, partly because this is a kind of recession or a kind of economic environment that's never been seen before, and partly because the Fed is kind of let the markets know that they're going to sit on the back end of the curve, whether through yield curve control or other mechanisms. So there's really no room that the rates market can get more expensive. And if you look at credit spreads, my colleague Jeff is going to spend a little time on this as well. There's a bit more room. You could see credit spreads tighten a bit from here, but not a lot. On both the high yield and the investment grade side, we're back to the lows that you see during strong expansions. So there isn't a whole lot of room for your fixed income portfolio to generate returns over the coming years. So what does that mean? Well, it means that if you're holding just sort of a passive allocation to equities and bonds, let's say a traditional 60-40, you're kind of in trouble because the forward returns that you get, given how expensive the market looks like right now, are not going to be very impressive. So what I'm showing you here on the left-hand side, the dark blue line is the 10-year forward total return annualized on the S&P 500. So in other words, if you look at 2010, you can see that that dark blue line picks up is pointed to at around 10%. It's on the left-hand side. So that means in 2010, the forward return on that moment was about 10%. So you were going to make 10% on your S&P holdings back in 2010. Obviously, I can't tell you what you're going to make in 2015 or 2018 or all the way up to now because that 10 years hasn't happened. What I can tell you is that that's very closely related to the price earnings ratio, which is on the right-hand scale, and it's inverted. And very, very simply, when the price earnings ratio is high, equities are expensive. It means that the price is high for what the earnings stream that you're getting. And if equities are expensive today, then the amount I'm going to earn by holding the equities over the next 10 years is less. That's just the way it works. So if the historical relationships hold, given current PE levels, you're probably looking at a return level of around 4% annualized over the next 10 years, which isn't great. I mean, that's quite substantially lower than you would have seen historically over the past decades or in the long horizon. And I got the same problem on the bond market. So on the right-hand side, what I'm showing you is a 10-year treasury yield. And I'm comparing that to the 10-year forward return for the corporate bonds, the Bloomberg Barclays. Sorry, it's no longer the Lehman Ag. And what you can see is that historically, there's a pretty tight relationship. Now, over the course of the past few years, actually, the corporate bond market's held up a bit, and that's been pretty impressive. But I don't think that that's going to necessarily be the case over the coming years. So, given where we are in the rates environment, I'm assuming that you're probably going to get a 1 or 2% annualized return over the next 10 years from your fixed income portfolio. So if all you're doing is passively investing and holding bonds and holding stocks, I think you're probably looking at a total return that's going to be really uninspiring. Certainly, below 5% annualized, and that's even before we take into account inflation. So what do you do? That's a real problem. What I think you have to do is you have to be more tactical. You have to be more willing to reallocate your risk to sectors, to styles, to factors that are going to do well. So this is a picture of just one sort of angle on that tactical nimbleness approach. What I'm showing you here is the difference between the highest returning and the lowest returning of the 13 top-level S&P 500 sectors since 1975. So if the best earning sector in that year is information technology, and the worst earning sector in that year is utilities, infotech makes 15, utilities loses 10, then that spread would be 25, just as an example. And so the dots are the actual spreads in those years, and the dark blue line is a 4-quarter moving average. So I'm showing you quarterly data here. And something really extraordinary happened over the past 10 years. Extraordinary is not the same as unprecedented. So I'm still okay. There was a really tight range within the U.S. equity market. And actually, this is true for the global markets. I'm showing the U.S. here because the historical data is longer and sort of more robust, but a really tight range. So the market went up and down without nearly the kind of dispersion that you used to see historically. And that's been about 10 years. So that's really helped to buttress the sort of passive long strategy, which has been very, very popular for the past decade. I think that's over. And you can already see it. There were some absolute winners over the course of the past year and some absolute losers. And now that's starting to rotate, which is a big part of our strategy. So you're going to need to be readjusting, I think, your investor headset from I can just buy the market and hold it, to I need to think about which sectors are going to do well, what looks expensive, what looks less expensive, because everything's expensive, and be a bit more tactical if you're going to want to achieve a meaningful kind of portfolio return. Now, this is a very big slide with a lot of words that I absolutely don't expect everybody to sit and read at the moment. And I'm certainly not going to read it to you either, because that could end up taking the rest of the hour. But this is a summary of the core views that are in our head on the team, and how we're thinking about what's going on over the course of the near term, the next few months, and the medium term, the next few years. Now, I've been forecasting for too long. I won't tell you how many decades. So I've learned the hard way that you need to be very cautious, not cautious, but humble about saying a specific number on a specific date. So that's why I'm not trying to overburden you here with, I think the euro is going to, X, and I think the S&P 500 is going to return Y. What I'm trying to show you is just sort of the general direction of where I think we're going. Right now, I think we're in the middle of a double dip recession. So I think you can see it in Europe, you can see it in the US, and I don't think anybody cares, because I think there's an economic surge that's going to be happening next year. And I think that's going to be followed by some pretty strong, but very uneven growth. But that is very dependent upon fiscal and monetary policy. Fiscal policy, I think governments are already running scared. I've never seen the circumstance where the IMF, the World Bank, the Fed, every central banker, every multilateral institution has been pleading with governments to borrow, 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 and spend, spend, spend. That is, I can't say unprecedented, can I? It's never happened before. And yet that's what's happening. So I think you will continue to see fiscal stimulus. The US will find a way to get this next $1 trillion or $900 billion package out at some point, whether it's under Biden or before. But I think at a certain point, they're going to have to pull back. And when that happens, it's going to be painful. So that's why in the near term, in 2021, that powerful thrust from fiscal and monetary policy is going to make the world explode. I mean, it's going to be fantastic. But after that, whether it's 2022 or 2023, who knows, that fiscal and that monetary retrenchment is going to be extremely painful. So on the interest rates front, you're looking at financial repression, Japanese style, and you're going to see rates kept low or even negative. Inflation probably isn't going to be an issue until further out, several years forward, but when it does become an issue, it could become pretty nasty. Near term, I expect dollar to continue to weaken, and I expect commodities to continue to be strong. Copper could hit fresh highs. I'm less excited about crude oil for sort of structural reasons, but broadly speaking, I think the commodity space is going to do very, very well. In the equities markets right now, we're very cautious. I think we've got potential for a pullback. I am a buyer of dips. I have been a buyer of dips for the past 6 months. I think that right now the market is probably ready for another dip, but there's also the possibility that you're going to have a melt up, fear of missing out. There is no alternative. People just piling in. And within that whole tactical dispersion argument, there are some things that I like. I like deep cyclicals like materials. I like value over growth. I like non-US over US. I like small to mid cap. That may change in 3 or 6 months. I'm not going to be wedded to a specific tactical strategy, because we need to be adapting to this environment because it's going to be sideways in sort of a wide and fat range, and that's the only way I'm going to be able to generate the returns for you, our clients. And then finally, fixed income, because that's really what drives it. The developed markets are just going to keep rates pinned to zero. Emerging markets are going to benefit by having lower rates, and that's going to be great for borrowers, EM borrowers. It's going to be really bad for just about everybody else. Investors are not going to be able to get the returns, and they're not going to get the hedge they need. So that's going to be driving liquidity into ever more interesting spaces in a hunt for yield. So I've really barreled through that, and I apologize if it was too fast. But I'm always available to take questions either now or or you can reach out to me offline, and I'd be happy to discuss how I've sort of developed this perspective, or what sort of underlying my views. So with that, unless there are any questions, which I don't see, then what I will do is I will hand it over to my colleague, Jeff, on the fixed income side.
Great, thank you, James. Good afternoon, everyone. I just want to begin by reiterating a point that James has already mentioned, and that's our view that we don't believe central banks have any maneuverability to increase rates. So essentially, we think that interest rates will remain low in their bid to reflate their respective economies. And a lot of the reason behind it is the soaring debt levels that we've seen, both government, corporate, and also household. And if there were to be any increase in rates in the near future, that would significantly pressure the abilities to repay debt. So using the Eurozone as an example, we've analysed the impact of yield changes at the debt to GDP level. We've seen that a 200 basis point increase in rates means that debt to GDP actually won't return to pre-COVID levels until 2040, so 20 years away. But a 1% cut in rates would in fact lead to debt ratios normalizing by 2025. So that means that central banks aren't just concerned about rates, but also about the direction and the quantum of any yield move in bonds. And if markets push yields higher, the ECB may be forced to indeed adopt yield curve control to stem a wave of corporate defaults and also household defaults as well. Now, we still think that technicals will be the key driver behind the markets next year. And if we just move one slide ahead, I've got a table that does illustrate these points. Now, we've held an underweight allocation to treasuries this year, and based on our outlook, we only expect to reduce that position further, actually, because under our base case, we think there will be some form of congressional approval of a stimulus package around $1 trillion in size, or 980 billion. And clearly that will lead to an abundance of US Treasury debt, which needs to be digested. And that will be almost 2 trillion of net supply forecast for the markets to absorb. So we do actually favor European government bonds over the US, and a number of Euro issuers will face net negative supply in 21 after redemptions and after ECB purchases. And that's why we continue to prefer Italy, because we think that that pool of lower rated paper will be in decline, and that the technical pressure will actually offset any fundamental weakness that we do see in Italy. And we look at the valuations in government bonds more closely. We actually project that Treasury yields will actually gradually move upwards on the back of an improving economy, and also the supply needed to fund all of this large-scale fiscal stimulus. For the 10-year Treasury, we think that the yields will move from current levels up to around that 1.25% area by the end of 2021, and the German 10-year bond will rise to the negative 0.25% area. Now, for the US Treasury, that 40 basis point move is actually equivalent to a 4-point decline in price terms. And that won't actually be sufficiently covered by the carry, or the coupon on that particular bond. So we are prepared to reduce duration in our US portfolios as early as, say, the second quarter of 2021. And the German bond, we think that will widen, and that's largely due to it being trading in sympathy with the US. But we're more interested in what we see in periphery debt. So we expect Euro periphery debt will continue to tighten towards the core Euro issuers. And we expect Italian bond yields to converge with Germany, given the diminishing pool of paper that there will be next year. So we continue to hold that, even though the yield is low. And that's what leads us to search for returns in the credit markets instead, where we think there'll be more interesting opportunities. Now, if we revisit fundamentals on the next slide, we see that, as is typical of recessionary periods, companies usually respond by bolstering liquidity, as they have done this year. What we've also seen is that non-financial companies have also refinanced their commercial paper through the very low-cost bond markets. Now, the question that we are asking is the pace at which corporates will actually transition into the phase of repair and actually start, well, to transition away from the phase of repair and deploy these elevated cash levels that they're sitting on into areas of growth. It could go into capital spending, it could go into shareholder rewards. Now, these are all useful gauges, but I like to focus on M&A activity. And we've seen that acquisitions for the full year, it's clearly down, but we have seen a very significant bounce back in the third quarter, notably with the pharmaceutical deals that we saw, and then more recently with the information and technology space where we've seen a couple of deals as well. Now, of course, the low cost of funding, it could continue to bring the M&A and LBO markets back around, but I think that any uptick in debt finance deals will be measured, and that's because we're at a time when debt leverage is elevated, interest coverage ratios remain very weak, and companies that are seeking debt financed M&A deals will no doubt see pushback from investors. And I've got to say that the rating agencies will also not respond kindly either. So what we do see from the chart on the right is that the use of cash to fund M&A has declined year over year, something that we welcome. We've seen more all-share deals. I mean, a good recent example is that S&P Global and the acquisition of IHS Markit, that tie-up, will be funded through an all-share deal, despite S&P having a very strong A3 rating, and it would be able to finance the deal at an all-in rate of as low as 1.4%. So I think the story will remain cash conservation through next year, but some pockets where companies will pursue growth. We also think that the technical picture will be very important for the credit markets as well. Now, looking at sentiment and technicals, since the Fed announced its backstop for credit markets, we've seen very impressive inflows into investment grade, followed closely by high yield as well. And demand for new bond deals has also been exceptional in 2020. Now, we can also see that now in the green line in the chart that I have on the left, that holdings in very low yielding money market funds are still sitting substantially above pre-pandemic levels. Markets are basically still awash with liquidity. And we do see investors wanting to put some of that cash to work in risk assets, especially on the improving backdrop in 2021. Now, next year, for the primary markets, based on the refinancing that we've seen since the summer and the much improved cadence of bond maturity schedules, we expect a lot less activity in the primary markets, and actually only 230 billion of net new issuance after redemptions. So all of this cash, where does it go? Well, I expect it to go into the secondary bond markets, into areas where we still do see attractive relative value, which moves me onto our final slide. Where do we see areas of attractive value? I mean, as James has pointed out, it's few and far between where we can actually find attractive areas now. It will actually be, in my opinion, lower down the credit spectrum. The single B, the triple C tiers are still trading some way off from the levels that we saw in 2017, 2018. And for this year, we had a bias to the crossover high beta, triple B, double B space. That's actually worked out to be a solid trade for our portfolios. But moving into next year, we do see an advantage to capture higher returns by just incrementally dialing up our risk appetite, particularly in the sectors we like. Now, two of them I've mentioned before. We still see and expect solid growth in demand for large ticket items in housing and cars. So we do like home builders and the automotive manufacturers as well, where we would now be more inclined to reach down to those lower rated single B bonds. Two examples are Beazer Homes and also Clarius Batteries as well. But we also saw in November how quickly markets can reprice bonds on any news of positive or accelerated vaccine developments. And we want to make sure that our portfolios actually capture any future rallies in 21, especially in those COVID impacted sectors. But I'm more comfortable in doing this through the highest quality credits that have the liquidity to hold out, especially because we do still face a number of known unknowns. For example, the phase 4 vaccine surveillance period, which should last 12 months, even if it is surveillance under warp speed. And of course, some areas that we've well discussed already in the markets, the potential mutation of virus strains, the recent changes in consumer behavior, whether they are a passing phase or whether they're structural. These are some of the risks that remain. So I do prefer to be higher in quality in some of those laggard COVID-facing sectors. So all in all, and in summary, in our fixed income area, where I think the direction of our fixed income strategy remains unchanged, but we're more positive on spread products, and we certainly prefer it over rate products. And our allocation has now allowed for more risk to be taken after evaluating the fundamentals, the intra-relative value between different fixed income sub-asset classes, and also the sentiment and technical factors as well. And with that, back to you, Simon or James.
Great. Thank you very much, Jeff. I can see that we're starting to acquire some questions. So what I'm going to do is, unless there's any specific questions right now for Jeff, I'm going to accumulate, because I think there are some questions from earlier on. I'm going to accumulate these questions, and we're going to hit these at the end so that I can go ahead and move it on to my colleagues, to Mikhail, and we can have a crack at the equities. Misha, I'm handing it over to you.
Thank you, James. Good afternoon, everyone. End of year webinar is a good time for us just to analyze performance of our equity strategy. And the two main takeaways, the performance actually was quite consistent, started from Q2, and that actually we managed to avoid large volatility, high volatility, and drawdown in Q1. Speaking about future, we expect recovery in consumption will be a key factor, which should underlie portfolio positioning and stock selection. We also will showcase your circular economy as a part of a broader ESG framework, which we are implementing in our investment process. Let's start with performance. Speaking about performance of our equity holdings as a standalone portfolio, it managed to deliver a return of 16.7% year to date. And it was quite consistent, started from Q2. It managed to deliver a quarterly return of 5% plus. And also, the strategy was flat in Q1 and managed to avoid drawdown in Q1. What is also important, these layers inside these bars, this actually diversification and kind of mechanics behind this consistency. We are being more titled towards growth stocks via our thematic investment ideas in Q2. We started gradually to add more value titling via single stocks. We also added core exposure via several style ETFs, namely we added exposure to global materials, value, small and mid cap, and also XUS international stocks. That is why when this rotation from resilient to recovery name started in the beginning of November, it did not negatively affect our performance of our strategy, because of these names managed to boost performance. At the moment, we 3 quarters invested measured out of our neutral equity exposure. We scaled up existing holdings in ETFs which are tracking global materials, value, small, mid cap, and international stocks. We also bought ETF which tracking FTSE 250, as we expect that once Brexit drama will be resolved, it will remove uncertainty, and it will be positive. On a single stock level, we sold stocks of Just Eat Takeaway. We're still thinking that food delivery services, these are kind of concept companies, and many of them still negative on not only earnings level, but also on EBITDA level. And we're thinking that next year will be not an easy ride for food delivery services, and we prefer to take more cautious stance towards the sector. We also bought stocks of Huhtamaki. This Finland-based company which are doing sustainable packaging, and it is a part of larger topic of circular economy, which we will touch upon later in this presentation. Moving further, speaking about 2021 positioning, we're thinking that it's important to be exposed to mixture of the combination of long-term and short-term drivers. We still thinking that those long-term drivers which underlie our thematic investment ideas are still valid. Namely, we still like online life, we like emerging market consumers, we like video games. But at the same time, it's important to get exposure to more short-term, mid-term factors, like already mentioned styles like deep cyclicals, non-US stocks, small and mid-cap, and value. And also, I would add that we expect recovery in consumption, and we're thinking that it will be key factor for stock selection and portfolio positioning in 2021. We think there is a large pent-up demand for holiday entertainment in 2021, which in turn should drive tourism spending, and also should positively impact air traffic. And this in turn should lead to large demand for oil and oil prices. But main unknown is still timing, because of for companies from affected industries, cash burn is still high, and we would prefer to invest only in stocks which got relatively conservative balance sheet, because we would prefer to not we can't make a clear view on timing when actually this large pent-up demand will be realized. Moving further and speaking about holiday season in 2021, we want to show you result of survey on the left-hand side of this chart, and it shows that actually consumers still not perceiving risk of being infected by the virus as a permanent threat of the modern life. In this way, COVID-19 is not flu at all. It really negatively impact consumer behavior. That is why vaccine will be a game changer for recovery in consumption. And also we expect that when it will be safe to travel, those group of customers who managed to preserve or even increase their savings during the pandemic will form a large part of this pent-up demand for leisure experiences in 2021. These are consumers with higher than average income. We already demonstrated data regarding rising income inequality gap during the previous webinar, and we're thinking that these group of customers which need to be exposed to. So also we've seen a lot of data points that shows that consumer planning is vacation for 2021. percentage of consumers who booked their holiday in 2021 steadily rising. That also confirmed by data from online travel agencies. On this, let us give you an update regarding our thematic investment ideas. And for this, let me ask join me Maksat, who gonna continue this presentation.
Thank you, Misha. Good afternoon, everyone. So the first the theme that I would like to talk about today is video games. We talked about video games industry multiple times this year, and it has been a hot topic and hot industry on the back of the pandemic and restrictions. And what I would like to show you is so the chart on the left-hand side shows gamers' activity as measured and in total number of players on the Steam platform. Steam is a major PC gaming platform. And you can see this as a dark blue line on the chart. So this year has seen a significant spike in player activity, especially during the lockdowns, and it has remained elevated compared to the pre-pandemic average, which is shown as a dotted line of the same color. Lockdowns are not the only measure that governments have been using this year to stop the spread of the virus. There are other restrictions and curfews, and this is actually represented by the red line on the chart, which shows Oxford stringency index. And as you can see, closer to the end of the year, as new lockdowns in some European countries have been reintroduced, but the same happened to the overall restrictions and curfews. And this has led to a spike in gaming activity again. So this is one of the short-term drivers. In addition to that, we have Christmas coming up. Also this year, new generation of consoles by Sony and Microsoft are being released. Therefore, this should act as a positive catalyst near term. Longer term, we still see video games as an attractive industry. The global games market, as forecasted by Newzoo, is expected to grow at almost 10% every year. And actually, the estimate for this year has spiked from 159 billion to 175 billion. So instead of 9% growth, it is the global video games market is now expected to grow by 20% this year. And again, this growth should continue going forward. Also, as more and more people were introduced to the video game space during this year, new habits have been formed, and we expect at least part of this community to continue to play video games as one of the leisure activities. And if we look at the global players forecast, by 2023, there is expected to be approximately 350 million more players. Now, moving on to another slide, we would like to talk about antitrust guidelines in China. And as a reminder, previously we have spoken about antitrust and big tech regulation in the United States and Europe. And last month, Chinese government released guidelines for internet companies. And those guidelines revolve around forced exclusivity, unfair pricing, price discrimination, and other measures within the industry. We have got 3 stocks in our portfolios, 3 Chinese stocks which are exposed to the or which operate in the internet space. However, we see limited impact on our holdings. Within that, let me briefly go through each stock individually. The first one is Alibaba, and this is probably the most exposed company to the guidelines, to the antitrust guidelines. However, we see no immediate impact on the company, and we see limited long-term impact. So first of all, Alibaba is the leader in e-commerce space in China. And actually, if the guidelines were introduced earlier, it would affect the company more because in 2014, Alibaba accounted for 3/4 of the e-commerce market. Today, it is approximately 60%. Moving on to JD, this is another big e-commerce player in China. It's actually the largest, it became the largest supermarket or online supermarket in China this year. And actually the potential impact for JD might be positive because the company only takes around 1/5 of the e-commerce market. And actually management was complaining previously about forced exclusivity and the fact that brands and merchants were forced to leave JD platform because of these measures. And therefore, if the guidelines will be introduced as they are presented right now, it might turn out to be positive for JD. The last one is Tencent. Tencent operates in several markets. First, so online gaming is not really exposed to these guidelines because those guidelines are targeted more towards transaction-based platforms, whereas video games are individual products. Some other markets or segments it operates in, such as online video and music, are not profitable yet, therefore they also fall out of these guidelines. And then last, the most popular product of Tencent, WeChat. This is actually an open platform, and a lot of businesses have actually benefited and grown out of this platform. Therefore, we see no impact on WeChat from the guidelines. And now today we would like to demonstrate circular economy as an investable theme within the broad ESG space. And overall, circular economy is all about minimizing waste, emissions, resource usage via reusing, recycling, remanufacturing, and long-lasting design. What is the main point of circular economy? The main point is that there are not enough resources on the planet for us to continue their consumption at the current pace. Actually, the global consumption of resources is 80% higher than it needs to be in order to for all the resources to be enough on a long-term basis. And actually, if we look at individual countries, the United States is the least efficient. To provide you some more specific examples on how inefficient the usage of the resources are, is 1.3 billion tons of food produced is wasted every year globally, and less than 1% of all textiles globally are recycled. So we need to use our resources more efficiently, and governments also understand this, and they introduce new measures, new targets in order for us to achieve more sustainable usage. And so, for example, European Union plans to achieve 55% of all plastic packaging to be recyclable by 2030, and they also plan to ban single-use plastics next year. UK set a target to achieve 70% recycling within the next decade. So these government policies then are also mirrored by corporations and consumer goods companies, which in turn, which is also mirrored by rising consumer awareness of sustainability importance. And if we actually, on top of that, there is also a growing need for supply chains to be local, which actually this year has demonstrated the importance of this, which in turn drives mitigation of operational risks, and this reinforces the long-term growth drivers. So this overall creates like a feedback loop for the circular economy. Now, circular economy is only a part of the broader ESG space, and within our team, our colleague Annie is very passionate about ESG, and on this, let me pass on to her to talk about ESG in more detail.
Hi everyone. Just trying to start a video. I apologize, we're running a little bit late, but I hope you still have energy for the last section of the webinar today, which is on the sustainable investments. Let me see if I can actually, okay, cool. Now I can do the video and you guys can actually see my face when I'm talking. Yeah, so this is our last section today. I will try to be fast and let you go in time. Last time I mentioned about the technicalities around the framework and the implementation of the different methodologies. Today, I actually would like to give some more market insights, show you the performance and fund flows, and some key points for our outlook for 2021. If we can go to the next slide, I can actually show you that we have seen impressive fund flows, not just this year's, but over the past few years. Historically speaking, it's been considered as a luxury by many investors that they can afford only during a boom market, especially after the last financial crisis. And it's been accessible only mainly through the active managers. But what we have seen in 2020 is that sustainable investments, including ESG, they're becoming more and more mainstream. The pandemic has had a little impact on the ESG inflows, if not accelerated further. The pandemic has highlighted the importance of many social matters, as I have already mentioned during the past webinars. People are still battling with the racial unrest with the recent movements of Black Lives Matter, or the natural disasters across the globe this year. So people are dealing with those issues on top of COVID. Investors are investing with more conscious. We have seen also, we actually have seen organic growth of demand already starting before the pandemic. The factors like indexation and passive replications via ETFs and futures and swaps, they actually have allowed to broaden the ESG fund offering at a lower price. In fact, the Bloomberg data show that the ETFs, the ESG ETFs, they have seen an inflow of total 22 billion until the October this year, which is already 3 times the total from last year. Of course, some holdings in these trackers, like my colleagues have pointed out during our internal debate, is some holdings are questionable. For example, the MSCI USA ESG leaders include McDonald's. I mean, besides the fact that the company has been under scrutiny for its treatment for the employees, I don't think the McDonald's burgers are considered the healthiest options when you come to healthy food. But this is mainly due to the lack of a consolidated framework around ESG, especially in the US. I will talk about it a little bit more in depth next slide. But overall, the ESG leaders, they pay off in a better share price, cash return, and lower cost of capital. So in the recent analysis done by Goldman, they have managed to show, by gathering all the data from my ESG leaders, that they have shown a good return over their weighted average cost of capital and the cash return on capital invested. And it is, even if Jeff has mentioned previously, like there's so much cash and the interest rates are so low, it is getting more difficult and more expensive for non-ESG compliant companies to get access to capital. And actually, not surprisingly, the credit rating agencies Fitch and Moody's, they are working on incorporating ESG factors in the credit scores as well. So, and as part of the European Sustainable Action Plan for the COVID, the EU Green Taxonomy has been designed to help channeling the capital flows towards more sustainable investments. So in the next slide, I would like to show you the actual performance. I picked the USA one and the European one to just to have a bit of comparison, so you can see the visible gap between the two markets. I mean, like a lot of investors these days are talking about the ESG bubbles because of the outperformance, especially during the sell-off, the market sell-off in March, in the beginning of the year. So a lot of investors are also trying to get in, but it's been one of the main debates among the investors. Are ESG factors actually contributing to outperformance? So here I want to show you that that the outperformance is visible mainly in Europe, but not necessarily true in the US. So the regulators in the US and Europe have been taking different approaches, very different approaches when it comes to environmental, social, and governance related investments. So policymakers in Europe, they're facilitating the integration of sustainability considerations into investment decisions. They're even proposing, that investment firms are required to consider the ESG preferences for retail clients when providing investment advice. Versus in the US, they've been taking a more conservative stance on the ESG investing. In fact, for example, the Department of Labor, they proposed restricting pension plans to casting a shareholder votes on issues that have an economic effect, which means a lot of ESG issues that they don't get votes. So unless they have a measurable financial impact. And Europe has been working on one of the, I would consider the most important regulatory work on ESG framework nowadays, which is the European taxonomy. Europe has been leading environmental efforts, with its Paris Agreement and the carbon neutral emission by 2050, which recently has joined by also, well, hopefully by the Biden's administration and by other countries like Japan and China. And he also launched the Green Taxonomy, which I've just mentioned is the most important regulatory piece of work on sustainable investments. It's a tool to help investors, companies, and financial institutions to actually define the environmental performance of economic activities across different sectors. So, this will likely to channel a lot of capitals towards companies that actually meet the taxonomy criteria. And last point I would like to highlight on this slide, it's the corporate resilience during COVID times. I mean, like we still need to gather more and more data and like quantitative analysis about the actual resilience of the companies. But a paper published by Harvard recently actually showed that the companies who have been considering ESG factors even before COVID, who have been focusing more on the stakeholders instead of just shareholders, they've been showing more resilience during a pandemic and surviving better the crisis. With that, I would like to go to the next slide, which shows the key points of our outlook for next year. I mean, it's not all rosy for ESG investments, even if now everyone talks about it. You will face both challenges and catalysts at the same time post-COVID. Like my question here is like, is it nice to have or must have? I think it will be a must have, even like especially given the recent regulatory advancement, also because of, I mentioned so many times that investors now care more and more about not just environmental issues, but also social and government related issues. On the E factor, actually, we've seen a bit of a loss of momentum. Because that has always been the most important factor for the investors, historically speaking. And with the recent trend of deglobalization, which started already before the pandemic, maybe the global coordinated effort will be more difficult. And this, I will write a piece about the effect of deglobalization on ESG next few months, and it will be also one of the themes that we'll talk about for the next quarter. And on the S and G factors, as I've mentioned many times, like people are watching the companies, they're focusing a lot on the corporate responses the companies have been providing during the pandemic. And a few key issues they will be they will be considered by investors. For example, the dividend, the executive pays, which have been really high for like the blue chip companies, and also the share buybacks. So these will be the key things that for sure ESG investors will watch more. So and the third point is the US market versus Europe. As I mentioned in my previous slide, it has been a huge gap. But US is actually catching up, both from an asset perspective, but also from a political perspective. We're hoping that under the Biden's administration, we'll see more effort both in the environmental side with his recent announcement of carbon mission by 2050, but also his recent not official announcement, but his willingness to break down tech companies, for example. That will also be one of the key S matters, but also the private data privacy. I don't know if you guys have watched The Social Dilemma on Netflix yet, but I mean, Netflix is an American company, even like they have been putting up movies about this. I think it will be one of the key issues. Just to conclude, so what should we focus on? Here, I would like to state that we want to hunt for tomorrow's leaders, because of course ESG leaders have been quite expensive, coming at the high premium, but we're looking for the improvers, providing more room for improvement from tomorrow. So yeah, we're hunting for tomorrow's ESG leaders. So with that, I would like to conclude today's last section. And if you have any questions, please do let me know. We will come up with more interesting ESG investment themes the next quarter.
That's great. Thank you very much, Annie. Okay, so what I'm going to do is I'm going to open it up to questions. We have one question already, and I'll take that one. But if you have any other questions, then please feel free to pop them into the Q&A. So the question is actually for me. It is, what is our oil price forecast? I think crude, and when I say oil, I mean Brent. I think Brent's going to make it up to about $65 a barrel next year, probably mid-year. I'm always very cautious about point forecasts. What I don't think is we're going to see Brent back over $100. And the reason there is there's just a lot of supply overhang. That capacity in the U.S. shale oil patch, it's damaged, but it's not disappeared. And I do think that there's probably been a fundamental, shift in the demand outlook. It's gradually declining here. But I also don't think we're going to touch 30 again. So I see crude as being sort of trapped in a range. And right now we're probably at the lower end of that range. As soon as we start to see people taking advantage of vaccines and unlocking to get back into travel, jet fuel picks up a bit. I think you'll start to wind through this inventory overhang that we have, and you'll get to 65 sort of mid to latter part of next year. Do we have any other questions? None? Great. Well, with that, then thank you very much for taking time out of your schedules to listen. If you've missed something, we will send you a link to the recorded session. And if you have anything that you'd like to let us know about, you can always email us at the email on the screen, marketing@dolfin.com. And I would encourage you to also follow up with a look at our website, where we do have plenty of our research materials available for you. Again, thank you, and I hope you stay healthy and enjoy your upcoming holiday season.